One of the biggest corporate stories we've been tracking over the last week and change at BNN Bloomberg is bank earnings. And at this point, we've basically heard from all the big players. And one of the common threads amongst most of them was the need to set aside more money for potentially bad loans in the face of economic uncertainty. Is that a reason to be shying away from owning this sector? Let's get some perspective on the investing side of the banks, especially as we look to the second half of the year, from someone who tracks them closely. Ebrahim Poonawala is head of North American Bank Research at BofA Securities. Nice to have you with us. I guess the first question I have is sort of a broad one. Would you say there is a common theme of the banks sort of preparing for a potential rainy day, just depending on what happens with the Canadian economy here?
John, first of all, thanks for having me. Good to be with you. So that was the common theme, right? There was one recurring topic throughout the last week was banks preparing for a rainy day. Whether or not how bad that rainy day will happen, I think no one knows. But clearly, all the big six banks build their credit reserves to prepare for what could potentially be a worsening credit outlook for them.
And, you know, I was citing some comments from the head of the largest bank, RBC, this week, who said, look, it's, and I'm paraphrasing here, it's kind of a no-brainer to potentially, to set aside money for potentially bad loans, just given the uncertainty. And if that worst case scenario does not materialize, we can always reverse course on that. But on earnings day, we did see some selling pressure on Royal shares. When you think about investing in bank stocks in Canada right now, overall, what's your feeling about it? Do you feel constructive? Do you think it's a place where investors should be willing to put some money to work?
So I think it's worth spending some time on the dichotomy that's going on here, right? On the one hand, you have banks building credit reserves with the view that things could look a bit more uglier 6-12 months from now than what they expected at the start of the year. But at the same time, when you look at the stock performance of these companies, they're all within sort of close to their all-time highs when you look at the bank index. So the stock performance, and I think how investors are thinking about this and discounting some of these risks is a bit different than what these reserve builds would imply. And I think as we look forward, I'm not sure I have better visibility on the macro today versus I had a week ago. There are two big swing factors. One is the Mark Carney administration. Do we start seeing proof points of, yes, this is going to be a pro-business administration, which will lead to a pickup in private sector investments in Canada over the next year and beyond? If that happens, it's a very constructive outlook for the Canadian economy and as a result for the banks. And the other aspect, as you well know, is how do the trade negotiations with the U.S. go? If we feel like we've seen the worst of it and there's continued de-risking there, that's another positive data point for the banks. So I think the banks are actually interestingly positioned. They build a lot of reserves. They're well capitalized. So I think on a relative basis, I think we are positively biased with the view that the Canadian economy can actually show some signs of life over the next year.
Okay, so when watching banks, also watch policy perspectives on both sides of the border. That kind of insight matters. When it comes to individual banks, though, are there any that you as an analyst are recommending over the rest?
Absolutely. So we upgraded the stock of TD Bank, TD, at the start of the year, and we have been very constructive on the name coming into the print. We remain constructive, and I think beyond, as you pointed out, the macro always matters for the banking industry, but beyond the macro, I think there is a bit of an idiosyncratic turnaround story going on at TD as they try to kind of ring fence their U.S. anti-money laundering issues. And at the same time, I think turnaround probably the last 5 to 10 years of so-so execution under the new CEO, Raymond Chun, who I think has hit the ground running, provided some early sort of positive proof points that investors can feel excited about. And I think as we look at their investor day towards the end of the year, I think there's a lot to like here, both today going into that investor day and what this franchise can actually achieve under some strong execution.
TD. So TD, your top name as they continue to work on progress with their turnaround. Any other names that you like out of, call it the big five, the big six?
Yeah, I think the other name that we think is interesting here is National Bank, right? And why do I say that? Part of that is to do with there's a lot of organic growth opportunity for National relative to the big five banks. So I think there is some runway, be it outside of their home market of Quebec, where they can grow. I think the deal that they just closed earlier this year of Canadian Western provides some synergies on the funding side, expenses, create some capital efficiencies over the next year. So I think there's a lot of idiosyncratic growth, the deal synergies, and you have a capital markets business that's very well positioned for this kind of a volatile environment, that even though investors want to discount the trends in that, it still remains a great source of earnings and capital for the bank. So we like National too.
Okay, so TD and National, two names that you're watching closely. Great perspective. Ebrahim, thanks very much. Ebrahim Poonawala of Bank of America Securities with a recap of the banks and earnings season.